On today's video, we're going to be talking about furnished holiday lets and the recent changes in the tax laws in the UK that mean that you can't offset all of your mortgage interest against the sales income. And we're going to just deep dive into what it really means and which goes beyond section 24. My name is Mark Ashworth.
I'm Neil Harding.
And welcome back to Property Insights. Furnished holiday lets. What has Jeremy Hunt done?
He shafted all the serviced accommodation users out there. Yeah, so bad
Brought them
news.
all into line with normal property investment, single lets, HMOs, that kind of stuff.
Yeah. The really annoying thing, I think, from all this is people are describing it as the tax advantageous rules around furnished holiday lets are being abolished. And I just think, well, utter nonsense. That it's the tax fair rules that are in place and were once upon a time in place for buy-to-let, single lets or HMOs. They're being abolished to bring it more into line with the tax disadvantageous rules that single let landlords now have to endure.
It's not like running any other business, let's say.
It's not like running any other business. You can't deduct your expenses against your income before you pay tax. Utter nonsense, but that's the world we're in. And that's the way furnished holiday lets, unfortunately, for furnished holiday lets operators are headed. I'm not a furnished holiday let operator.
No.
Neither are you, Mark, but...
Well, we know a lot of people in our network that are.
We do.
So we know it's a popular strategy. We know that, obviously, when we say furnished holiday lets, that does fall into the same category as serviced accommodation, which is, people who are using accommodation on a short-term basis. And it doesn't necessarily mean they're on holiday. They're often using it for work purposes. When there's a big, massive sort of construction project or there's a lot of infrastructure going in, employers are essentially pulling people from the whole country to come and work for them, and they need, short-term accommodation, and they might only be staying in it Monday to Friday.
So first thing to say is that the effective date of this is 6th of April 2025. So there's there's a year of grace, if nothing else, before people have to adjust to this. But unlike the transitional rules for single lets, which were actually brought in under the old George Osborne tax, as it's called, over a 4-year period, this is essentially, you get 1 year's notice and then the whole lot's going to come in. So, there's not that much time to adjust to this. Yes, it's not just about section 24. Also, what it means is that the income from your furnished holiday lets will no longer count towards your what's called pensionable income, right? It used to, and it won't anymore. So in other words, if you receive £50,000 of profits for property that you own in your own name, and you were previously thinking, right, I will put in 30,000 of that or 10,000 of that into my pension, well, that 50,000 no longer counts as pensionable income. So you're not going to be able to use it anymore to top up your pension.
Right.
Which is going to be a big impact for a lot of people. Single let landlords have had that for years now. So you're going to have what's called earned income, so air quote, earned income, which is, if you're an employee, that's earned income. That can count towards the amount that you can put in as pension income, and you can put up £60,000 a year into your pension and still have the tax benefits of doing so. So I think that might not have been something that people have quite clocked yet, but that is part of the parcel and package of changes that we're looking at.
But interestingly, so if you run your serviced accommodation business as a limited company, I'm guessing then that obviously means that you can still put that profit from that business into your pension, no problem. But it's only if you earn it personally in your own personal named serviced accommodation business, yeah?
That's correct, yeah. So if you're operating within a limited company, if your employer makes pension contributions, that's fine. If you take a salary from your company, then you're having earned income. You can then make a contribution to your pension, yeah. The next bit, it's a bit taxy, and I'm going to try my best to keep this as succinct as possible. But it is important for people that were thinking of doing this, and it's around capital gains tax. So there is such a thing called business asset disposal relief. So for people who have a residential property, residential investment property, you may well be aware that the rate of capital gains tax for property that you own in your own name is either 18% or 28% if
24.
you look to sell the property, and it's going to be 24% due to the budget changes very soon. Now, what some people actually would have as a tax strategy in order to get, if they want to sell a property, in order to pay capital gains tax at 10%, if you ran a residential property as furnished holiday let for 2 years at least, and it met the criteria and was therefore a qualifying asset, you could claim business asset disposal relief and pay capital gains tax at 10%. There are other criteria as well, but that's the crux of it. Now, of course, key point there is you've got to be running it as a furnished holiday let for 2 years. So you might have decided last month, 2 months ago, that you were going to do this because you really wanted to sell the property, but you're going to run it as a furnished holiday let, and then maybe in year 3 sell it and pay tax at 10%, which is perfectly within the rules. That, unfortunately, is no longer going to be possible for you. You've missed the boat on that. So someone that even started this strategy 6 months ago is probably not going to be able to do it anymore, because by the time the rules change, it'll be too late. So yeah, not great. So, you know, I don't think the drop from 28% to 24% is going to be much.
So I wonder if that's the reason why they dropped the capital gains tax to 24%, in order to balance up the fact that you can't claim business asset disposal relief on your furnished holiday let. And that's basically because you are running service. Well, they consider service accommodation to be more of a trading business rather than an investment business, and so therefore that's why you could claim that relief on the disposal of the asset or the sale of the asset. I always thought that was that was an advantage, I think, which I think they basically just, plug in the loophole, should we say.
And if you're thinking of trying to sell quickly to get business asset relief at 10% on your disposal, the government have already thought about that. There are anti-forestalling rules in place effective the 6th of March 2024, which means that you have to be able to demonstrate that your intention to sell was in place prior to that date, which I suppose basically means if you had it on the market with an estate agent prior to the 6th of March, then that probably would be okay. But you can't quickly sell it before the 5th of April or something, Yeah.
The UK government, eh?
Yeah. So
anything more?
Yeah, something else they brought in. So those wishing to change to serviced accommodation or furnished holiday lets will require planning permission in the future.
So that means that they're basically just, I suppose, whether you think you can make the numbers work or not, you want to have a service accommodation business. It's going to come down in line with, having more than 6 people in a HMO, where you would need to get planning permission. And obviously it's going to depend on the councils, which side of the bed they got out of that morning, maybe. I don't know.
There'll be some permitted development, I think, in some areas and for existing operators. But for anyone looking to go into it as a new venture, you are at the mercy, I think, of that. So, and also, all units will need to be registered with local authorities, similar to sort of an HMO licensing arrangement. And with that becomes more visibility and transparency. So if anyone is out there running a serviced accommodation unit on a buy-to-let mortgage, dare I say it, then be careful. You want to be thinking very carefully about that, and shouldn't be doing it anyway. But we know it goes on, right? It goes on. People do it, of course they do, and I think it's a very, very good idea to get your mortgage compliant for what you're actually doing. It's always the right thing to do anyway. But now you might well be found out with that increased visibility of licensing. It all begs the question: if you've got property in your own name and you're running it as furnished holiday let, what can you do? And it's a case of speak to your accountant and take advice. And for people that have got single let buy-to-lets, they had this dilemma and dealt with this years ago. Now, one route that a lot of people have done, apart from selling up, is go the limited company route. So if you're in a limited company, as we said earlier, if you're in a limited company, you can deduct your interest against your mortgages, against your rental income, as you would expect to be able to do. So incorporating is an option. In order to do that, you've got to do it very carefully, because otherwise you're going to incur capital gains tax, you're going to incur stamp duty costs, and it's going to be expensive, as well as your legal costs and other transaction costs. So make sure that you speak to an accountant and see whether or not you can go through the incorporation relief route. So via a partnership, claiming incorporation relief into a limited company, it normally takes 2 to 3 years though, but as we said, you've got a 1 year grace before these rules fully kick in. You'll probably get stung in 2025, 26, but at least there's perhaps light at the end of the tunnel.
So we hope that you found that insightful, and we look forward to seeing you on the next one.